just coming off of a long holiday weekend, that pivotal phone call with the European Union's Commission president seems to have sparked a lot of optimism overseas. Should it spark optimism here, or are you more cautious?
Yeah, and thanks for having me, Contessa. So here's what I would say. Europe's really just following on what's been doing most of the year. Go look at bank gains, for example, in Europe. Banks have been making really good money the last year to 2 years. That continues to kind of fall forward. You're seeing a lot more spending in Germany. There's an article this weekend about MERS saying to make deep strikes into Russia, through Ukraine. And so I say that because it seems to be that Europe's very much on their front foot. This call to get this laid out with Donald Trump is very much in the camp of we just don't want to break anything. I think the United States is having to take a much more pragmatic view of this because obviously, tariff day came and went, caused a lot of economic fears. I think the difference is for the United States, we are coming off of the idea of American exceptionalism being kind of the idea of the moment late last year and early this year. The only problem is we're doing that on borrowed money. And so we have this tenuous place where, do you let the 30-year go to 5 or 6%, or do you deal with your economic reality, which we've borrowed too much money? That's just a very different place than where Europe sits right now.
And what do you expect to hear? I mean, we're going to hear from Neil Kashkari, the Minnesota Fed president. Yeah. We're going to hear from the New York Fed president, John Williams. What do you expect to hear from the people who are leading the Fed about where to go from here?
Yeah, it's a really good question. So the history is that the Fed will blink. I mean, that's just the history of this. So, for example, you have this idea of rates, and then you have the economy. And for the Fed, it's inflation and full employment. Okay, well, again, the history argues that you have inflation on this because we borrowed so much money. If you look back, we borrowed a lot of money in World War I. That was to fund our allies. And then World War II, we obviously did the same thing. But as soon as those wars ended, we tightened our spending right away. That's the big difference now. Even this year, Scott Bessent's saying, hey, we'd like to get, he said originally, let's get our GDP, our deficit down to 3 to 3.5%. The difference is now he's saying, well, let's grow our way out. Okay. The problem is that just takes a lot of time, and the government spending is tough to get out.
Your company has $7.8 billion under management. How are you positioning clients right now amid the uncertainty of are tariffs on, are tariffs off?
Yeah.
Where do we go?
Yeah, and I think what the Liberation Day in April did was heighten the idea that people are really worried about the economy. Okay. Now, in comparison, we're talking about like a 30-year at 5%. It doesn't seem to be that the stock market's greatly repricing itself based on a 30-year at 5%. So it's interesting to think about asset markets versus the economy. Okay, the economy continues to chug along despite people worrying that what could go on with Liberation Day could really sit on the economy. What I think I noticed more than anything is if you talk to a business owner today, they're really worried about tariffs in general. You go talk to Joe and Jane six-pack on the street, they don't care. So this is kind of a rich people problem, right? If you own assets, if you run a business, this is a big deal to you. But that's a small part of America. Middle America, Main America, I'll call it Main Street. This is not that big of a deal. If you look at the economy's done fine through, but that's a lot tied to government spending.